Okay, good afternoon, ladies and gentlemen. Welcome to Shine's Trading Room. Today we have a super valuable educational seminar today where we're going to be discussing going over the fiscal cliff, which is on the forefront of people's minds right now and in focus, especially coming into the end of the year 2012 and 2013, beginning with a whole new set of rules. So without further ado, I'd like to welcome a good friend of mine, a super talented, qualified, a genius planner, Scott Lasky, to give us some information today to help better plan for today and for tomorrow. So Scott, I'd like to pass the mic over to you so you could hop in, and welcome.
Thank you, David, and thank you all for joining me this afternoon. Today we're going to talk about, as Dave mentioned, a few strategies, a few realities, a few fantasies about what may or may not happen over the next, call it 3 weeks, as CNBC has their fiscal cliff countdown clock on. We ourselves have one right here, and we're thinking constantly about how to maximize our clients' tax situations, and looking forward as well as looking backwards in terms of what's available for them and what might be available for you out there in the audience for yourselves to take advantage of what's going to be, as Dave put it, an entirely new set of rules. And we are up against a new set of rules as it pertains to income tax, capital gains tax, dividends tax, and estate tax. All of those things will impact almost everyone in this country on some level, but certainly some more than others. What's the important news and the good news is we haven't cut a deal in Congress, and until we do, or until they do, there's still lots of available options to take advantage of the current tax regime. What we do know, taxes are going up unequivocally on certain transactions, and even if there's a very Republican-oriented deal out in Congress, there's still going to be some increases that people aren't even considering. So we'll get started right here. Over the cliff we go. This came out of Newsday. I'm a Long Island kid, so I was reading Newsday, and there's a lovely political cartoon which talks to you about what's the current status of what's actually happening in Washington. It's a still life. The truth is, as we've seen before, the last few years in Congress, we've seen last-minute deals before Congress goes out for the Christmas break, and it looks to be this is going to happen again this year. I don't know who's watching CNBC. Harry Reid was on there pushing those Republicans to get somewhere. It looks as if before Christmas, I think we'll have something done, because nobody really wants to see this happen on either side of the political aisle. This is not a political discussion, by the way. So what really is the substance behind what's going to happen if we don't get a deal? Well, it's really rather draconian when you look at what actually happens here for almost any way you can earn money, whether you're trading for money, whether you're a salaried employee, whether you're a self-employed person. Tax brackets are moving in the opposite direction of the way you want to see them move. Even people as low as the 10% tax bracket are going to see that wiped out and move to 15%. I mean, that's a 50% increase from where I come from. And as you get up into the higher pay scales, the brackets are going to revert back to Clinton era rates, like 39.6 on higher earners from 35%. That's a 4.6% increase. There's not much we can do about this. What we're very likely to see is, regardless of what happens, whatever kind of deals we cut, we are likely to see these brackets move up in similar directions. You might see a little more room on the lower end here. Maybe the 10% will stay. But it looks like if you're a high earner, ordinary income, W-2 income, you're going to see your rates probably move up pretty marginally here. Two things to remember here, and these are two basic tax lessons. First is, it's always on the next dollar of income. So the way tax brackets work work out, it's up to 30,000, it's up to 70,000, it's up to 100,000, and so on. If you're in the 35% tax bracket and you make, a few $100,000, and you're sort of worried, well, I don't want to earn more money because I'm going to wind up paying 40%, 39.6 on my next dollar of income. That's not the way it works. It's kind of like investment management fees, if you're familiar with that business. Basically, on the first dollar of income, everybody has to click through these brackets. So, your first dollar of income is charged at 10%, then 15 as you click through those brackets. So if you're on the margin, on the high end of that tax bracket, what you'll see is an increase with your marginal rate, but it's only on the excess income. So it's still a good thing to earn more money, not a bad thing. The other thing that's very important here is all the things we're talking about today are going to be day of things. And so what I mean by that is when Congress finally does decide to get their act together, and John Boehner and President Obama finally come together on a deal that everyone can live with here, a compromise, typically what happens in these things is those rules are effective that day, and they're not going to wait, especially when it comes to the estate tax and other things. And so the time to act is today, before the deal is cut, and while the current rates are where they are, because what we're likely to see is when there is a deal finally made, it's going to be effective on that day. So if we wait till December 23rd, then on the 23rd, that final week of the year, you're not going to have to go scramble and refigure this out and do what you thought you'd have time to do once you knew what the rules were going to be. It's going to be a day of deal. So all the techniques and things I'll talk about in a few minutes, really, if you're thinking about it, if you're on the fence as to whether you should take a gain or not, whether you should make a gift from your estate or not, the answer is just do it. There's sometimes ways to unwind these things, but that's going to require more personal consultation. So another issue that's going to happen here is capital gains and dividends, and this is a very big deal. So capital gains taxes are we're likely to see long-term capital gains move up from 15% to 20%. And dividends at the same time are going to move into your brackets over there. So most people who have high dividend income portfolios and people who are earning a material amount of income from dividends, they're going to see that click into somewhere into those brackets. It isn't going to be 15% anymore. It's not likely to go as high as 39.6 if you're a high earner, but the truth probably lies somewhere in the middle. And so one thing that people aren't calculating here, and this is not part of the fiscal cliff negotiation, is that plus I put in here, which I'll point to on the screen, which is the 3.8% PPACA. What is PPACA, you ask? More affectionately known to the public world as Obamacare. That 3.8% surtax on long-term capital gains for high-income earners is going to happen. That's in addition to 5% increase that we're likely to see, or some marginal increase that we're likely to see on those long-term capital gains rates. And so we'll talk about what to do here in a few minutes, but that's important to remember. You're going from 15 to 23.8%, not from 15 to 20. That's not a 33% increase. It's more like a 50% increase. So there is some time to do some planning and perhaps maybe sell those gainers into a strong market. The payroll tax holiday is over. This was a backroom deal we did at the end of 2010. And right now, if you're earning W-2 income or you're a 1099, you're actually paying 2% less than you've always paid for the last couple of years. That's expected to expire. Both Democrats and Republicans are generally supportive of this, and so we're very likely to see that 7.65% FICA Medicare deduction from your paycheck happen again. Other things which are sort of small little annoying things that are going to creep back into your tax return while your marginal income rates may not move all that much. The child tax credit is going from $1,000 to $500, so that's a 50% decrease. The marriage penalty is reinstated, which has really been not something. And so what is the marriage penalty, you ask? You can take many people can take a standard deduction, which is typically $5,000. over the last couple of years through the Bush tax cuts and then the deal we made in Congress in 2010, they doubled the deduction for married people and sort of eliminated this quote-unquote penalty. It doesn't matter if you itemize deductions, but for people who don't, the marriage penalty basically is going to reduce the size of that available deduction. And so what all this adds up to, a fair, bigger bite out of your tax bill come next year. Moving right along here, estate and gift taxes are a big source of consternation for the left side of the aisle, and what we've had is really an exceptional opportunity in the last couple of years for wealthier individuals, let's think one percenters, who have incredible opportunities under the current estate tax laws to gift money down to their children, to their grandchildren, and there's a $5.2 million exemption, meaning you can give $5 million to anybody today that you couldn't do a few years back, and as of January 1st you won't be able to do again. And so the gift tax, that's known as the gift exemption. Right now we have the sort of lifetime, death time as a unified credit. It's known as what's likely to happen is sort of the bifurcation, which is what we've had in the past. It looks as if Congress is going to probably cap a lifetime gift at $1 million and not go all the way up to the $5 million like we've seen this past year. But the big number also here is estate tax is going up to potentially 55% from what's currently 35%. And so when you add it all up, for people who have a good amount of wealth, but maybe not exceedingly wealthy, we're not talking Warren Buffett, Bill Gates, we're not even talking maybe some hedge fund managers, but people who've made a very good living are sitting on several $million, be it IRAs, personal residences, secondary residences, and brokerage accounts and savings accounts, etc., other assets. It's easy to amass a stockpile, or not easy, but often can be a stockpile amassed that might be subject to future federal estate tax. And so the techniques that I'm pushing here under the $3.5 million exemption, looks like Congress will support that. But these other techniques, such as grantor trust, grats, and other ways that wealthier individuals can move money outside their estates, which are very favorable in terms of the tax regime, are likely to be more restrictive. Grats are going to have longer terms. Grantor trusts are going to be restricted. These are great ways to move money from parents down to kids, from grandparents all the way down to grandchildren, and anything in between. And so before we move into next year, the time to take action is today. So what can you do? And that's what everybody's interested here. What can you do to better your tax situation? Well, number one is look at highly appreciated stock positions that maybe are in and around your portfolio. So selling this year, basically the recommendation is, let's say you bought Apple in 2002 before the iPod came out, and you bought it at $15 a share, and you're sitting on what's effectively a zero basis and a very big long-term capital gain. If you're okay with holding on to this position for a number of years into the future, you have no need for the income, no need for the money, and it's something that you don't ever plan on paying tax on, or not any time in the foreseeable future, the answer is you probably don't have to make a sale, and you could probably push out that tax and continue to defer it. However, if you are thinking that within the next 1 to 2 or even 3 years on your horizon, you are going to be thinking about liquidating a portion of this. Maybe you want to buy a house. Maybe you're sending a child to college. Maybe you have a need for that money. Maybe you're going to retire, and this has been your nest egg. And it could be any stock. It doesn't have to be Apple. It could be any highly appreciated position that you've owned for some period of time. Selling today probably does make some sense because really you're going to pay a significant greater chunk to capital gains. I just did the math back of the envelope with a client, and they've got several million in some highly appreciated zero basis stock. We said, what if you sold $2 million? The difference between selling today and selling January 3rd is $176,000 in capital gains tax. Where I come from, that's real money. So you should look at reallocating your portfolio. If you're equity heavy, you've got gains, and you've been thinking about doing it, if anything, your life situation changes, you might as well take the action today, accelerate that, because the break even is 8.3% on the money, meaning you have to earn at least 8.3% 3% on the liquidation value today, next year, versus doing it today. And so it does make sense to potentially accelerate some of those capital gains. So reallocate those portfolios as well. Take losses. Well, if you've got a material capital loss, if you've got a carry forward, actually, believe it or not, it may make sense to push off and wait till next year. Any loss is worth more when tax regime is worse. And so if you're going to take losses, but you're sort of holding on for something, or you're thinking when's the right moment, you might wait till next year to go ahead and do that. What else can you do? Can you accelerate 2013 income into 2012? Are you running your own business? Are you expecting receivables? Is there a way to push forth income into, pull income into this year versus next year? You might pay tax a little sooner on that income, but again, we don't know where the brackets are going to land exactly, and so you might save yourself 4 or 5% on marginal income rates if you can accelerate that income. Alternatively, another thing to do is you could slow down some of your deductions. And so what often we tell people to do is to pay their next year's property tax bill this year. And usually the reason for doing that is you accelerate your deduction into the current year by paying next year's bill, to the extent that you have the cash. In this case, it might actually make sense to go the other way and push off some of those future deductions when your ordinary income rates are higher, your capital gains rates are higher, and those deductions will actually be worth more to you next year. When we're talking about making gifts and estate plans, again, now is the time. As I mentioned, these rules will generally be effective the day we cut that deal and the day the legislation is going to be voted on. And so if we don't go over the cliff, the estate rules are going to be revised and issued, and if the dates on your trust documents, if the date on your will does not predate the date that Congress cut that deal, you're going to lose some of those wonderful deals that we have available today. So, consider making a gift if you've got children, if you've got grandchildren, if you're looking to make a tax-free gift over in that direction. There's no time like the present, there really isn't. And then update your estate plan and make sure that come next year and come in, the end of this year and into next year, that your estate plans are reflective of what the current environment is. That means looking at wills, revising them if necessary, making sure that the current exemptions, making sure the beneficiaries and IRAs are the right people, and doing all these very important things. And so at this point, I'll open the floor to questions. I don't know if anyone has any here, but by all means, feel free to type them into our chat room. Here's Bob S. If I didn't cover it already, any unusually high 1099 income coming in during the last week of 2012? Well, Bob, I think that's actually a good problem. It's better than coming in at the beginning of 2013. And so, if you could push that off, I would say ordinarily you should wait. If you're on a cash accounting basis through your business, you should wait until, you can't do it if you're on a cash or an accrual basis. You could wait until 2013 to take it. But truthfully, depending upon if you saw the first slide, I'll put this slide back up here on the income rise in the tax brackets. And so depending upon what bracket you fall into, you're up against what could be 50% higher federal income taxes, but it could also be as low as sort of 10% more. If you have a lot of, if you're not expecting greater income next year, or if you're getting paid in 2012 for something you're really going to do next year, you might actually then accelerate deduction, contrary to what I said, to offset it in the current year where the income is received, rather than in the future year when the deduction won't be worth much. So it does, all of these advice pieces that I'm giving really have to be customized, and I'm happy to discuss it with anyone in the room here on a one-on-one basis, but I would need more information from you as to your specific situation before I could say to you, this is exactly what you should do. But I would say if you have the idea, Bob, and you're going to have high income this year that is not going to repeat itself next year, then you would accelerate whatever deductions you could into the current year, because they'll be worth more to you this year. If you're in about the same place, you should push those deductions off into next year. That's fine. They'll be worth more to you then. I think we're going to see higher rates no matter what. But I'm happy to talk offline or via email. I'll put up my contact info, and it's been sent out, I believe, on the email, but we'll look it over again. BC, what are my thoughts on eliminating state tax payments being deductible off federal. Well, that's exactly what I was talking about. You can, oh, you mean in terms of whether they'll be deducted. This is another big question that I think one of the things going on in Congress, the horse trading that's going on in Congress, and this is where we don't have clarity and we don't know where we're going to land. We can kind of look at a state tax and sort of see where the political wind has landed us in the middle here, because we've had several years of this back and forth and what the Democrats will accept versus what the Republicans, and we kind of know what that target is. This year, everything has changed with respect to they're talking about the home mortgage interest deduction being back on the table. Well, I don't personally think that's where that's going to be taken off. It might be limited. Right now, it's currently 1 million up to 2 residences, primary and secondary. It may decrease to $500,000 of sort of mortgage value that you can deduct. It may be there may be some state tax payment pullbacks. What's likely to happen is it's going to happen on the higher income people no matter what, and some of the lower income people won't be phased out as fast on this stuff. I personally think state tax payments will always be deductible. It is a double dip on the federal government side, and the states really won't support that kind of thing. And so I think you're likely to see more of these deductions get eliminated before the state tax deduction. And then I said to wait on tax losses, it would be beneficial either way. You can carry them forward, so technically that's correct. But what I was going to say here is, if you're sitting on something that's basically definitely a loss, and you're going to have roughly the same amount of capital gains, or if you have capital gains this year, technically they're worth more next year, because let's say you're going to do a gain and a loss swap in 2013, technically the loss is worth more dollars then. If you have a carry forward, then of course, it will be benefiting you either way. It's sort of the same difference. If you don't have a carry forward and you have gains in the current year, well, then you would want to take the loss. But if you don't have gains, or you're looking to push them forward, then next year would make some sense. I mean, it's a personal situation. If you already have a carry forward, it probably does make sense to hold it over and take gains next year to use it, but it really depends on the personal situation. If you don't have a carry forward, you should probably take those gains and pay the freight if you're thinking of doing it in the next year or two. So anyone else have any questions? By all means, the floor is open. We don't quite know. What I'd like to do perhaps is maybe come back next week when we have a little more clarity on some of this, and we'll up the ante and see if we've got any more vision on what Congress appears to be likely to do. My personal opinion is I think we are going to see the capital gains rate move to 20. That 3.8% on dividends and capital gains, remember, that's going to be there regardless. That is not currently being negotiated. That's part of the Obamacare package, which was passed by Congress, is scheduled to go into effect, and is not something that's really part of the fiscal cliff. But as you can see, the 5% capital gains increase plus that, it really is much more material than just a 5%. And so we're here for you. There's other things like IRA deductions they're talking about eliminating in 401k. I also think these are not likely to be removed from the tax code anytime soon, but it is something that Congress is looking at. Right now, almost everything appears to be on the table, and so we'll just see where we land. So I'll give the floor one more round of questions if anyone's got any. My contact info will post up here right now. Feel free to give me a call, the number, send me an email there. I'm happy to discuss individual situations with you free of charge. And good luck to all of you for the rest of the day and for the rest of the year as we navigate these markets and these. Does a deal happen tonight? Well, I think the answer is yes. Nobody wants to see the cliff happen. This is a huge problem for the economy. Ben Bernanke on the record yesterday came out and said he doesn't want to see it happen. President Obama doesn't want to see it happen. Even Speaker John Boehner doesn't want to see it happen. The Republicans, the population believes that if we do go over the cliff, it's going to be the fault of the Republicans. While that works in the president's favor, it does mean that everyone really does want a deal. What doesn't work in the president's favor is the economic harm that would come of not getting a deal done. And so what's very likely to happen, has a deal ever not been reached? The answer is no. We always get these deals. In the last couple of years, the political brinksmanship has really been ratcheted up significant than we seem to cut these deals last minute, right? We had the debt ceiling negotiations, which ended at the very last possible minute. In 2010, we had the original expiration of the Bush tax cuts, which were then extended, and then there was some political horse trading. That's how we landed at this $5.2 million exemption. Andy, that's a short-term capital gain. Is still considered ordinary income, so that's a long-term capital gain. That's where we're looking at going to. So short-term will still be, again though, if you're in a high bracket, you're going to be subject to that 3.8% on top. And so dividends, if you're in a high income tax bracket, could literally go as high as 43.4% on dividends from 15% today, just on the federal, plus whatever lovely state you live in. If it's not Texas or Florida or Arizona, you're going to have state income tax to pay, and a couple more on that list too. But where we're broadcasting from, New York, where I live, New Jersey, we've got high state income taxes, and those are not likely to go anywhere, unfortunately. And so thanks all for spending some time with me today. Feel free to chime in or ask some questions. If you want to ask Dave Shine a question, or anyone here at Shine's Room, I'd like to thank them for having me on today and being able to espouse some wisdom. I'm not a CPA, I'm a certified financial planner, but my father's a CPA, and so I'm steeped in it. But if you need some advice, feel free to drop a line, and we can probably help you with your specifics. And so, Dave, I'm going to hand the floor back to you. Thanks again. Send us an email if you have any questions, and best wishes.
Okay, guys, that wraps up this educational series or educational seminar by Scott Lasky, CFP. Certified financial planner. Hope it gave everybody out there a little more clarity on what's going on, fiscal cliff drama. So we will see in the next couple days how things develop. Thank you for joining us. Let's head right back to the live trading broadcast here in Shine's Trading Room. Enjoy. Have a good day.